All right, all right, all right. Thank you, everyone, for coming tonight. We are going to go ahead and get started. Appreciate you guys attending. Hey, if you've got the webinar screen up and you have a chat, you'll notice you should have a chat in the bottom corner of your screen. Feel free to use that throughout tonight. Ask questions when you have them. We are going to spend a minute at the end as well, and pause for some Q&A too. So we'll get your questions answered. But if you feel like you want to, go ahead and drop them in the chat as we're going through tonight. Appreciate you going in. If you're on the chat, go ahead and drop where you guys are calling in from. I know different parts of Arizona. Maybe there's an out of town or two. Anyway, yeah, it'd be great to hear where you guys are calling in from. While you're doing that, I'm going to go ahead and dive in. Phoenix. Yeah, we got Phoenix. We got Scottsdale. We got Queen Creek, Tucson. Yeah, that's great. That's great. All right, let's dive in. I'm going to give you some food for thought as we start. Okay. I saw this a long time ago and I've just hung on to it. I love this quote. And I want you to think about this kind of as we go through the night. Like, what am I doing with my finances and does it need to change? What am I doing with my strategies, my financial strategies, and do they need to pivot a little bit? Am I constantly hurting, trying to catch up, trying to get ahead? These kinds of things. We'll touch on those ideas through the night. But people change in 4 different seasons, he says. He says when they hurt enough that they have to, or when they see enough that they're inspired to, or when they learn enough that they want to, or when they receive enough that they're able to. That's John Maxwell. So I've always loved that quote, and I think it just always got me thinking on when do I choose to change? When I do choose to make changes in my life. You might hear tonight some things you really love, and you're like, hey, I need to do that one day. One of these days I'm going to do that. I hear it all the time. I hear it every week. One day. Let's make today day one. Okay. And I'm going to get around to it. So let's get started. If you feel that's what you're saying, I think the time is now. I'm going to kick this over to Olivia, let her introduce herself.
Hello, I am Olivia McGraw, and I have been an official Infinite banker before I became an agent. I think, let's see here, almost 7 years ago. My husband and I started implementing this concept, and we are using it in 3 different ways at the moment, other than just what it was originally set up for. And so if there are mistakes that have been made, I most likely have made them so that nobody else has to, so I can coach other people on how not to do that. But also just like it's really empowered my husband and I to get buy our first real estate investment. And we're excited to kind of share some of the wisdom that we've gained along the way with you all. We also have Marcus Maloney on here, who's one of your AZREIA resident powerhouse leaders. So hopefully you all recognize him too. But he's been implementing this, and I have a couple of questions for him later, just to kind of give you all a word that's not from us, but from one of your own, of how he's using it and what that's done for him. So we'll chat more on that in a few minutes.
Good deal. So my name is Jason Powers. I've been practicing IBC, I don't know, for about 10 years now, maybe. I heard about it a long time ago. Someone was talking about how you could recapture debt. And at the same time you're paying down debt, you could build up cash value. And I was like, that's just sorcery. There's no way. So I called the guy, and he showed me how to do it. And I was like, holy smokes, what have I been doing my whole life? So I implemented it. I've still got that IBC policy, and I use it all the time, and it's benefited me in so many ways. And then who would have thunk when I got into it, I'd be doing it as a career, which I didn't see coming back then. So I love it so much. I've been doing real estate investing since 2008 after the market crashed. I got into it. I was watching friends and family literally lose their homes. And I was so frustrated because there wasn't anything I could do. And I don't know what you don't know. And so I got into it to help distressed homeowners find alternative solutions, and got into the wholesaling and things like that. And that was my objective. And then I worked, I did the wholesaling and worked into fix and flips for a little while, got into the buy and hold scene. And then, have done that over the years, short-term, long-term rentals, stuff like that. Ended up buying a 170-acre former camping and recreation area several years ago that had been shut down. We started renovating that. I've since sold that off to some other people who carry the torch forward. And so I've done my fair share, and every step along the way utilized IBC. And it's just an amazing tool. And so I love the fact, like Olivia said, we've both been practitioners of it before we got into it as a career, and utilizing it in our own lives. So I hope you'll see that tonight as we dive in. Okay. So a couple topics, I think in life, there's a need for life insurance and estate planning. We've kind of forgotten about some of this. We think life insurance is boring. We think estate planning is boring. We keep putting it off. Remember I said early on, I need to do that one day. And then we do it. And then one day comes and it's too late, and so there is the need for that. There's a need for disability income protections. I talk about, we're not going to camp on it tonight much, but if you become injured or can't work or immobile for a while, what happens to your income? Does everything go sideways? Do you have that protected? So just think about that. But there's also a need for generational thinking, which I think we have lost. And this need for generational thinking is just something I think is so important nowadays, especially nowadays. We used to be really good at it a couple generations ago, just thinking one or two generations away. So think about that tonight, and whatever your situation is, how do we think about the next generation as well? And then lastly, there's the need for controlling the banking function in our lives. And that's what we're going to talk about most of the time tonight, is why do we need to control the banking function? What does it do for us to control the banking function? And if you're into the buy and hold scene, sounds like most of you are, you're dealing with banks all the time. When you need that property, what would life be like if you never had to borrow from an outside bank again? If you could build up that privatized family banking system and get to a point where you're never having to borrow from an outside bank again, finance your own deals, it'd be an amazing thing. Okay. Nelson Nash, talked about him quite a bit. He sort of came up with the idea behind infinite banking. He says, if some authoritative power distributed all the money in the world equally among all the people in the world within 10 years' time, 97% of the money will be back under control of 3% of the people. Well, why is that? It's because they understand how to get money to flow to and towards them instead of away from them. Okay. So think about that. I want to talk about a couple of human behaviors, and bear with us. We're going to set the stage, lay the foundation, and then we're going to get into some case studies later and build on that. And then a lot of this we'll just bring it home. This will make sense. But there's a thing called Parkinson's law. It's 3 parts to it. Work expands to meet the time envelope allowed. What do I mean by that? Think of if you've got let's say you bought a property and you got a contractor who needs to remodel the bathroom. You say, okay, I need it done in a week. He says I can do it in a week. So he gets it done in a week. And then a couple months later, you buy another property, send the same guy in to do the same kind of bathroom, same style remodel. And you're like, we're not in a rush on this one. We have a month. But in your head, he can do it in a week. How long is he going to take to do it? We're going to take the whole month to do it, right? So work expands to meet the time envelope allowed. We are humans. That's just what we do. Okay, I'm not picking on contractors too much, but it's just what happens. If we can get that under control, we can change the game a little bit. Second part, a luxury once enjoyed becomes a necessity. So I had a great conversation about 2 weeks ago, and I immediately thought of this. We had a big blizzard here, and a gal, she was standing at the door and pointed her keys out and did the remote start to warm her car up. And she made the comment, I will never get a car without remote start again. This is such an amazing thing, and it's so this luxury now becomes a necessity. And that's immediately what I thought of. But we do that throughout our life. The third part is expenses rise equal to income. As our income increases, we tend to raise our standard of living right away, and then we eat up any excess. It's just what most people do. Okay. So if we can control this, if we can overcome these kinds of things, and it's almost a daily battle, right? But if we can overcome this daily, we will win. And as Nelson Nash says, if you cannot do so, you're destined to become a slave. And I think that's so true. We have to learn to sometimes withhold the luxuries we could be enjoying just for a season. It's not, as I tell my kids, it's not no forever. It's no now. And we'll see what happens. Okay. So who's really in control of your money? What do we do in life? We finance everything we do in life. Credit cards, houses, cars, you name it. We finance everything we do in life. Who's in control of our money? Okay. Generally, it's the banks. Well, what would it be like if we could control that aspect of our life? And if we could have our own banking system in place, okay, losing control of your money is the most profitable thing you can do. Learning to control your money, is the most profitable thing you can do over a lifetime. Second human behavior is the arrival syndrome. And I bring this up because we do it so much. I talk to, so many people a week, and there's a good handful. And now you guys are here and you're learning, and that's amazing. So I don't think you're part of this package, right? You're here to learn, and you attend these AZREIA meetings to learn and absorb and grow in the way you think about real estate and what you can do with it. But basically, the arrival syndrome is we already know all there is to know. It's like, I don't need to hear about this because I already know what I got, and I know it works, and I don't need to know nothing else, And I would encourage you as we go through tonight, if you've never heard of infinite banking, open your ears, open your mind, and hear it out. And it is, you have to change the way you think about your finances. What we're not going to do tonight is teach you how to change your real estate strategies. We are going to teach you how to change the flow of your money. And there's a difference, okay? And you can turbocharge your real estate strategies with that, okay? So we've been talking about money. And this is the last kind of quote, tidbit thought I've got, and we'll dive into some facts. But when it comes to your money, what do you want to do with it? Think about that. How much would you like to have? When do you want it? But more importantly, I think the most important question is why? Why do you want all this money? Well, I want to be able to finance my own deals. Well, yeah, but why? Well, I want to get some passive income. Yes, but why? Well, I want to retire. But, what are you going to do when you retire? Just thinking about these things and knowing the answer, I think for anybody in any situation helps guide your decision-making a little bit better and a little bit clearer. And then you start seeing maybe opportunities you didn't see before, or maybe turning down opportunities you would normally just take because you didn't really know why you were taking them. You're just taking them. And maybe it's not within alignment of what you're really trying to do, So know your why. But again, I said it before, we got to change the way we think. Now, Einstein said it best. We cannot solve problems by using the same kind of thinking we used when we created them. We have to change the way we think about our finances. All right, Olivia, I'll let you handle it.
All right. So this is just one of my favorite slides because it kind of illustrates our traditional approaches to money. And the first one is just simply the American way. We are a debtor society. They say, and this number might have changed since the last time I heard it, that the average American has $18,000 in credit card debt. So, we know that there's a type of good debt and bad debt. We're talking about bad debt here. And so the name of that game is that we go into debt to buy a new car, buy a new house, whatever it is. And our whole goal is to end with nothing. So to pay it off, and get back to nothing. And what's the alternative to that? Well, the Saver Society, the Dave Ramseys of the world of like, don't go into debt. Debt is bad. You want to save your pennies, save. Then you go pay cash for that car. And then you save up again. And then because you're going to need a new car eventually. And so the problem with both of these ways of thinking is that the whole goal is to end with nothing. And so you're giving up, there's a lost opportunity cost in both situations of what the money could be doing if you are surrendering that money either to buy a new car or to get out of debt. So what is our alternative? Well, the alternative has an understanding that there is a cost to start any system. There's a cost to buy any piece of real estate, right? There's a cost for your down payment on that property. There's a cost to fix it, but eventually the goal, just like fix and flipping or buy and holds or anything else, you want to recover that money back. But instead of just getting back to nothing, instead of that money just reappearing back into your bank account, when you're implementing the infinite banking concept, you not only recover that initial cost, but your money is literally growing with compounding interest until the day you pass away, until the day you die. And that's what a wealth creator understands. That yes, there's a cost to get going. We're not ignoring that. That's part of this whole thing. But there's a cost to start any system that's worth doing. And so getting going is what's most important. And having that money building momentum for you even though you're taking that same money out, same money that you would be using to buy a car, same money to invest in real estate, but it's growing for you multidimensionally now. So it's growing both inside the concept and outside the concept in your real estate investments.
That's great. So one final human behavior I like is this Willie Sutton's law. If you don't know, if you've never heard of him, he was a famous bank robber. He kept getting caught, and he was interviewed one time by a reporter who basically said, "Why do you continue to rob banks?" And he's like, "Well, that's where they keep the money." And so the principle really is wherever wealth is accumulated, someone will try to steal it. And I don't want to get political tonight, but we all know if we're making money, who's trying to take a good cut of it? Okay. So wherever wealth is accumulated, someone will try to steal it. So can we have a system in place where we can curtail some of that throughout our life for our generation, the next generation even? Okay. So we can enter the infinite banking concept. If you've never read this book, you can pick it up. You can go to infinitebanking.org. We'll give you a link at the end. You can buy it from us. But it's a 92-page book. Matter of fact, when you cut out the glossary and index and all this, it's 72 pages long. So it's not a hard read. Pick it up. It is where the idea of infinite banking really came from. And it's why we do what we do. Tell you what it's not and what it is real quick. It's not some financial hack. Okay. It is about taking control of the banking function in your life. It is the best place to warehouse your wealth. It's got guarantees, safety. You can access your money now. Take control of the banking function. Okay. 5 rules of IBC. You'll read the book, so you'll know. Take the long view. Let me think long range. Okay. I'm a real estate investor. You're real estate investors. We are a conundrum. All right. We have the ability to, go after buy and holds, for long-term gain. And we're thinking long range. We're taking the long view when we start doing that. But on the flip side, we are some of the most impatient people I know. We want that deal done yesterday. We want that thing closed now. We want to, and so we have to find this balance. And with infinite banking, you really need to, it is intended to, replace the banking system in your life over time. So you need to build that up over time. Now, there's ways to turbocharge it early on, et cetera. But the principle behind it, you got to take the long view. You can't be in too much of a rush. You're just going to hurt yourself. It's like yelling at a tree to grow faster. Give it time to grow. It's going to be a good tree. It's going to last a long time. Okay. Don't be afraid to capitalize. Once you understand IBC, that will make sense. Once you get it, the question then for most people is like, oh, well, how much more can I get in? Because the growth is so good. Don't steal the peas. That's a reference from the book. It means be an honest banker. You would not steal from the bank, so do not steal from yourself. Pay yourself back. When you borrow against yourself, pay yourself back. Don't do business with banks. If you can control the banking function, and we've talked about it, rethink your thinking. Okay, what is it? The vehicle through which we teach people how to do this is, I'm going to kick this over to Olivia.
The infinite banking concept. So it is a properly structured, dividend-paying, permanent or whole life insurance policy from a mutual carrier. And so in using this vehicle, all of these elements here that are highlighted are actually essential to the whole thing working. Okay. So I like to say that not all life insurance is created equal. Not all life insurance companies are created equal. And how a policy is actually structured is essential to actually getting this concept working. So unfortunately, we see it all the time. 2 situations. One situation is somebody learns a bunch of things from us, and then they get their buddy who sells life insurance to try and do this for them. Guess what? 9 times out of the 10, it doesn't work because the guy doesn't know what he's doing. And it's not his fault. He's selling life insurance. What we're doing is teaching people how to bank. Okay. So this isn't life insurance for the sake of life insurance. This is properly structured. And so in setting the policies up the way that we do, they are going to rapidly accelerate using compounding interest. And the money, every dollar you're putting in towards the policy begins growing more than $1. And so that's essential to making this whole thing work. The other thing we often see is somebody already has a policy or they have a handful of policies. I'm working with somebody right now, folks. Between her and her husband, they have 15 policies. And it's almost jaw dropping. And she's not old. Okay. The only reason why I think somebody should have that is that they have multiple properties, they have multiple businesses, real estate holdings. This is because she has a cash happy financial advisor who likes to open policies and get paid once a year on those commissions for all those policies. It's not because she needs more. And so on my end, it's a little frustrating because I'm like, oh my gosh, we can definitely do something way better for you. So not all hope is lost. We can group those policies and put them into a new functioning infinite banking concept for them. But again, not all policies are created equal. So we're designing these policies to have cash flow very quickly and to recover that initial cost very quickly as well. So the average whole life policy won't recover costs for 15 to 20 years. We are making sure that you have that money back in your hot little hand within 6 to 8 years. And so that's usually our goal. There's a few exceptions on why and how that can't happen, but we can go into that later. Mm-hmm. So what it does is create uninterrupted compounding interest, even while you're using the money, which is the powerful point. So this isn't saying set it and forget it. This isn't saying start your life insurance policy and then we'll check in and with you in 10 years or when somebody passes away. That's not how this works. We're teaching people how to bank, to put money into the vehicle and pull it right back out and put it into work for you in your real estate investments or a car purchase or anything else. Do you want me to keep going with it?
Sure.
Okay. So part of that, the growth on this is income tax free. So that's essential. Okay. So a huge why we love helping people set up these strategies is to exit the tax plan. And so a question we often get is, can I put my 1031 money in? You have to pay Uncle Sam at some point. So what we want to do though is put money into a vehicle where you never have to pay taxes on it again. Part of the trick is in the language. It's in the language of loans. And so that's why we loan money from our policy. Even if it's a loan you don't intend to pay back, i.e. retirement, you want to live off of that money. But guess what? 100% of all people die. So when you die, that loan is first reimbursed by the death benefit and everything left over goes to your beneficiaries. Let's see, what else do we have here of why this is amazing?
Yeah, it's a good vehicle. You're using it now throughout your entire life, and then you can use it to supplement your retirement later. And it's just this diversified vehicle. One vehicle accomplishes a lot of different things. That's why we talk about this multitasking dollar, which you'll see later. So you can use it now, use it to make you money, save you money, and it's growing inside the policy, and you can use it to supplement your retirement later. It is not an investment product, and it is an asset. So we're not talking about market. We don't have to deal with markets and what they're doing or the rise and fall of markets. You don't have to watch it. When the markets were crashing, people's policies were fine, and they were still continuing to access their policies as they were. Okay. Loans, when you borrow against a policy, they're not tied to your credit. That's important, I think. When you take a loan against your policy, you, me, and the insurance carrier know, and that's it. Whoever else you decide to tell. Furthermore, unstructured loans, when you borrow against that policy, you get to dictate the loan terms. How much am I going to pay back? When? How long am I going to take to pay it back? So if you want to take a day, a month, a year, 5 years, 10 years, that's your prerogative. And we'll show you, on another time, the intricacies of a policy and how that works. We've talked about doing multiple things at once. And then lastly, the generational wealth transfer. Whole life, nothing new. Been around since the 1700s. I love this. It started out as a corporation for relief of poor and distressed widows and children of Presbyterian ministers. So I say that 10 times fast. It started because ministers were being supported by the church and their families, right? And if they were to pass away, families were no longer supported and all of a sudden left destitute. And so they came up with this idea. How do we keep helping them beyond that? Who carries life insurance? Olivia, who carries life insurance?
I'm sorry.
Banks.
There we go. Banks. Yes. Billions with a B every year of life insurance. And so this is no secret. It's public information. So if you look up, and I like to pick on Wells Fargo because that's where my unfortunate bank account is. They literally buy billions of dollars in life insurance every year with the money that you and I put on deposit. And it is literally a case of saying, do as we say, not as we do. The problem with this, and this is a deep, dark rabbit hole, if anyone, not a conspiracy, fully factual truth, you can go dive into this information and look at yourself, is that the money we know isn't actually there. So it's not in that vault in the back of the room. It is fictitious, more or less. And you're like, well, where else am I going to store my wealth? Well, that's the conversation we're having today. But what happened, everyone thinks their money is safe until it isn't, right? We have very significant short-term memory loss in our country. So what happened March 2023, 1 year ago, that was big news all across the headlines? I don't know if anyone wants to chime in on that. Marcus, you can too.
Yep, bank failure.
Silicon Valley Bank failure. Yeah. And what did they specialize in? I don't know if anybody knows this. Trivia.
Loans, commercial loans, right?
Commercial loans for startup companies. Okay. I don't know how many tiny little companies I follow on Instagram that were posting things like, sorry, hang in with us. We're so sorry. Our money is frozen right now. Why? Because they were too slow to transfer the money that day. And literally, this happened, folks, without anyone breaking any rules. Okay. The rules are designed for failure. Actually, the rules are designed for us to all believe into the system where they're too big to fail. Guess what? We've all heard that before, right? So what's happening behind the scenes is that banks don't have to anymore. So the rule used to have to be banks had to keep 10% on reserves in that vault, wherever, for what you and I have on deposit. During COVID, those rules changed. Okay. There's more rules that are broken beyond this. The rules change and banks no longer have to keep anything on reserve for what's on deposit. Okay. Now the problem gets even worse because they are allowed to loan off of what you and I deposit. Okay. So the old rule, 10%. So Jason deposits $10,000 with Wells Fargo. I need a $9,000 loan. Okay. I go in, they're going to loan me $9,000 of Jason's money. I take that money. I apply for a loan, finally get that money. I'm going to do whatever with it. But right now I'm going to deposit it back into my savings account with Wells Fargo while I'm waiting for that deal. Guess what? They're going to take that $9,000 and they'll go loan that back out 90%. But again, during COVID, all the rules change and they can loan 100% of that money out. So Silicon Valley Bank just got caught out. All right. And this literally could happen. By the way, here's a little insider hack. Credit unions are different. They're not banks. So if you want a little bit more security, I would say operate with a credit union because they're owned by the people, like a mutual insurance carrier. But banks, they're out there to make a buck. And they do that by loaning money and charging exponentially above and beyond what you and I receive for what we get in our savings. I think it's about 400% more they make off of the very 0.2% that they return to us for using our money to make money. Life insurance companies are very different. They have to have $1 in assets for every $1 in liabilities. Okay, what is the liability? Not that you and I want our money. It's that we die before they expect us to. So that is the bigger, and they have to pay it. It is a legal contract. When I put my money with Wells Fargo, yeah, everyone says, well, $250,000 is FDIC insured. How is that going to help you when your money's frozen? Great that it's insured. How long is it going to take for Congress to pass a bailout for that bank? How long is it going to take for that bank to release that funding, for another bank to come in and save them? I think Chase is the one that ended up buying out Silicon Valley Bank in that example. In the meantime, every little startup company was frozen. And, they still have creditors or people that have loaned them. They have, supply chain needs that they're having to pay for, and their money's stuck in the bank. So anyway, so all this is to say there's a safer place to store your money than just the traditional way in the banks, because they are buying life insurance with it. All of these companies have a fun origin story of using infinite banking or life insurance. Walt Disney couldn't get a bank loan when he wanted to start the silly little fantasy land for kiddos. And so everyone thought he was wild and crazy. And so he's like, well, fine, I'll just take the money out of my life insurance policy. So we have Disneyland as a result of that. Ray Kroc, what was that one, Jason?
Yeah, when he bought out the McDonald brothers, he actually used cash value from two different policies to pay some key employees. And then he actually started a marketing campaign on his newest mascot. Any guesses who that might have been? Mr. Ronald McDonald. So we joke, hey, maybe Mr. Ronald McDonald wouldn't even be around if Mr. Kroc didn't have life insurance. Who knows? Who knows if he could have done it? Furthermore, who else knows about this? These dignitaries, they get it, they understand it, understood it. Interesting article came out on President Biden when he had to disclose his finances, talked about how he owns 0 investment products and 6 whole life policies, which is actually kind of interesting because he's probably not broke. And so you start going, well, wait a minute, what is he doing? And we don't know what he's doing with his policies, but it is an interesting fact. Okay, so people are out there using it.
This one, by the way, but I heard the other day that presidential candidates run campaign money through life insurance policies. So check that one yourself. But I was like, well, that's interesting.
I believe it.
Yeah.
Well, let's dive in. You guys ready to see some examples? All right. I'm going to give you this first example. This is based on an actual client, and his situation was he lives in a small town Midwest. He was buying rental properties in a little college town for cheap, and then obviously renting them. By the time we had met, he had 18 properties going already. And what he was doing was he had a day job too, so he didn't really need the income right now. He was just storing for later and stockpiling more properties. As he would have enough saved up from free cash flows, he would buy another property. And so by the time he heard about IBC, the question was, well, hey, would this similar strategy work, except through a policy? And that was the discussion we had, and we ran all kinds of numbers to see what would work for him. And so the idea, again, let me recap that. The idea is now instead, we talked about earlier, changing the flow of the money. Now, instead of taking the rental income and putting it in a savings account and letting it sit there until he has enough and buy another property, we're going to pass it through a policy first. Now, let me show you that. A lot of numbers over the next couple examples, and I don't want you to get hung up on the number of zeros. If, like this guy's example, he was going to run $36,000 a year through a policy for the first 10 years. Now, for you, we'll find out what works for you in your situation. If it's $3,600 a year or $360,000 a year, we'll find out what works for you in your situation. So again, don't get caught up on the numbers. Just understand the principle behind it, what it's doing, how it's growing, and why it's growing. All right. So you can see in the red box here, he's putting 36 in year 1. He could borrow 23 of it right back out where it says cash value. All right. So now what we're going to do is, as we build up enough cash value each year, we're going to borrow against the policy and buy the property. You with me so far? All right. So this is the spreadsheet we built for him. We'll build one for you too if you want. See what it looks like. So don't get caught up on too much here. I'm going to highlight some things. So let's see. Let's highlight. This is the annual premium column. Can you see that highlighter? All right. And then over here on the right is his net cash value that particular month or year, however this is monthly. So, all right. So what we're going to do is the first year, remember, he can only get about 23 of it right back out. So there's not enough in there to buy a property. All right. The next year he pays in premiums, but now there's enough in there. So he takes a $50,000 loan against his policy, and he's going to buy that little college house, a little 1 or 2 bedroom house. And then he's going to set himself up with a repayment plan. Now he is the bank. Okay. So his rental income for that property is going to pay he set himself up with a 4% 20-year AM loan. All right. So do the math, $303 a month. So he set himself with a $303 a month repayment back to the cash value pile, if you will. So he loaned himself the money. He loaned his real estate investment business the money, and the real estate investment business via rents is going to pay that principal loan back over time. He will continue using the income from the other properties to pay premiums. So that's the second year. By the third year, we skip a year actually. We don't have quite enough in there because it's still growing. It's still early in the life of the policy. But then something interesting happens. By the 4th year, we have enough to take out a second loan and a second property, second repayment. So you see those payments jump from 303 to 606. But then what's interesting is now he's still paying 36 in premiums, but now he can get 50 out every single year. Okay, so he put 36 in, he had plenty in there to get 50 out the next year. So year 5, he does it again. Year 6, he does it again. Year 7, he does it again. Year 8, he does it again. And you see what's happening now? Every year he's paying premiums. He's also starting a new loan with himself. So each property is responsible for its own loan and will pay that principal back over time. But his cash values, because of the compounding growth and the way we structure that policy, is now growing quite efficiently. He's putting 36 in. He can easily pull 50 out every year now and keep doing it. So for him, the play is let's stack however many we can get to retirement. So we just stopped. We just said, hey, what if we stopped borrowing after 10 years? So you see that second arrow on the left where we don't take any more loans. Now he could choose to keep borrowing however he wants to do it. And then you see his total payments from those 8 properties he now has is $27.27 a month back to the policy loan. And then on the far right, you see his cumulative cash value rising and rising and rising. 1, because of the premiums being paid in. 2, because of the loan repayments. 3, because of the dividends, which we haven't talked about tonight. All right, so it is continuing to grow. Any of these dollar amounts he has access to that year, that month. So that's 12 years in. Let me fast forward, show you something. This is now 17 years in, that red box at the bottom. He's got a cumulative gross, if he had all loans paid back, over $561,000. On the far right, because he still has outstanding loans, he does have $351,000 stacked in there. But what's interesting, remember early on, that first illustration I showed you, we only paid the $36,000 for 10 years. And then we reduced it down to $12,000. Okay. And because we've done that, we've done that because it's growing efficiently. All right. So he's now down to $12,000 a year after year 10. And this example here on the screen, year 16 to 17, he paid $12,000 in premiums. His cash value grew $36,000 that year. So forget the policy for a minute. In any other situation, would you pay $12,000 to make $36,000? We'll sure you would. But not only that, because he's also paying the principal loan amount back, that 1 year he had a total cash value increase of $52K just that 1 year that he can recycle into something else if he wants to, or just let it stack up and utilize it for retirement. You can pay the loans back at any point. Remember, it's an unstructured loan, so there's no one's dictating how you pay that loan back. We just, for example's sake, we said, hey, we want to pay this back, 20 years. You can do it in 5, 10, 1, whatever. If he has a windfall later, and this is also not accounting for maybe he's going to do cash out refis potentially if he wants to later for some reason. If you could be the bank, be the bank. But then you've also got the growth of the asset, right? So your equity growth on top of it all. So the cash value is growing, the asset is growing. Okay. So it's just a fantastic vehicle through which you can do this. So by 20 years in, he's got $662,000 gross. He's still paying it back a little bit. So he's got over $500,000 available. And that's just one example, one policy. You're not limited to the number of policies you can have. You can get policies on you, your spouse, your kids, your business partners, as long as it makes sense. There's insurable interest. Makes sense. We went through it real fast, but we're going to hit 2 more case studies. Olivia is going to have a good chat with Marcus here next, and then we'll get back into 2 more case studies so you guys can see a little bit more.
Yeah. So again, please, if you have questions, chime in, but we just wanted to ask Marcus just a little of his experience with infinite banking, since he has been with us. Full disclosure, he's one of our clients. I had a lot of fun working with Marcus and his wife and getting this set up for them. So Marcus, would you just briefly tell us why you wanted to implement the infinite banking concept?
Sure. Thank you, Olivia. Thank you, Jason. First off, just kind of going back, looking at the history when I first found out about infinite banking, it's something that you catch in your Instagram feed and your YouTube feed, and you're like, okay, I don't know, that's a scam. It's impossible. People can't do what people were talking about. And I remember distinctly, I was sitting in one of my flips, and me and Mike with AZREIA was doing a podcast with Unbridled Wealth. And I'm like, while we're asking these questions, I'm like, oh, this is what I was looking at that was in my Instagram feed that kept popping up. And as we kind of went through the podcast and Olivia, you and Jason was explaining everything, it had hit me right then. I had been probably about a week earlier or 2 weeks earlier, I was praying and I was just trying to find out a good way to gain compounding interest, right? Because Albert Einstein says the eighth wonder of the world is compounding interest. And I was like, okay, well, how can I get some of that? I'm doing these flips, I'm wholesaling, I'm doing all of these transactions. And I was putting up some of the money into rentals, but I was like, there gotta be another way in order to do it. And then once I took some time, and trust me, guys, I'm a skeptic. I don't believe anything the first time I hear it. I'm a researcher. I go back and I research. And after that podcast, I took about a good 2 weeks and I just researched and tried to learn everything I could about infinite banking, got the Nelson Nash book, read through that, and I was like, okay, wow, this is amazing, right? So then I decided to do it. Again, that flip that we were sitting in, sold it, made a nice chunk of change. And then I reached out to Olivia. And trust me, guys, this is no sales pitch, nothing like that. They just asked me to give a testimonial on, why I like it. And it's because you can use $1 multiple times. And I'm like, where else can you do that? It's like impossible. So instead of me having $1, it's like I have $3. So now imagine if you have $100,000, you have $300,000 to use. And once I learned that, I was like, okay, this is amazing. And then I just kind of went on from there and just started using it. So I don't know if that answered your question, Olivia, but I just wanted to do an introduction, really.
What, so you said that you are a skeptic. What were the things that you were kind of skeptical about or your reservations before we kind of dove in?
One was, how can you use $1 multiple times? That was one thing. And then a confused mind says no, right? So I was confused about everything. So I was like, no, this can't be real. You can't do this. It's impossible. But then once I opened myself up to say, okay, well, let me see how this is possible, because I did the same thing. I went and researched and I was like, okay, Walt Disney did this. All of the presidents have, whole life insurance. The whole Ray Kroc story. I looked at that and I was like, okay, with these, multi-billionaires are doing it and they're creating that generational wealth for their families, then there's something to it. And so I was a skeptic. But I just went in and I looked, and because I didn't understand it, that's when, Olivia, you took the time. And trust me, guys, Olivia, I think I asked you almost every question I can think of. We was on a Zoom call for like 2 hours and then got off of that. And then I was like, oh, I thought of another question, but then email you questions you were answering. So it was great. It was great. So
what has surprised you about this journey and this process?
You know what? How easy it is to have access to your capital, right? Because I have a self-directed IRA and I put money in that IRA also, but it's so difficult to pull that money out, and then you're getting taxed for it, for using your own money. And then once I found this out, I was like, oh, I can put money in here and I can pull it out as simple as sending you an email, Olivia, and you send me the paperwork and I sign off on it. And it was like the next, between 24 to 48 hours, I had access to the capital. I was like, oh, okay, this was a no-brainer. And again, full transparency, I use it for my real estate holdings. So put money in, withdrew the money out, went and bought a rental property, And now that rental property is cash flowing for me ridiculously.
Yeah. And it's also not a set it and forget it program. I meet with Marcus at least at a minimum once a year, but and even then, and we're not afraid of these questions, but it's like, remind me how this works again. We go through it and we kind of talked about some of your deals. By the way, I don't share any numbers, so don't, but like that's all your information. But we were talking about something, one of his rentals, and I'm like, well, Marcus, you could actually pay that property off with your policy today and make your own money on that instead of the bank. And we're like, wait a minute. And I don't remember, it was just that aha moment of like, oh, okay, that's right. This is how this thing is supposed to work. And so let's implement something like that. So we're not, we don't disappear. We always joke, but not joke, but like literally like we'll be working together for the rest of one of our lives. So I hope you like it. So it's like, we get to know each other really well and dive into that. We're also available to like answer questions and help folks kind of, that spreadsheet Jason was showing. I built one of those out for Marcus to be like, okay, here's what we could do. Here's how those numbers could work. So is there anything else you want to just kind of share about your journey and experience?
Yeah. So when you sent me that spreadsheet on, how it would work, I sent it over to my CPA and I was like, is this real? Can this be done? And she was like, yeah, you know what? Our company does infinite banking. Our CEO does infinite banking. It's a great strategy. And then from there, she gave me the green light. But one of my aha moments was when we were talking about the rental property. I had bought the property and I was paying, I think it was 8.5% interest on the note. And Olivia was like, well, why don't you just pay it off with the money that you have in your policy? And now you can pay yourself back at 4%. So I gained like 4.5% savings on the interest, plus the money that I put into the policy is steady compounded. And I'm using that dollar, multiple times. So it was, it took something. I had to explain it to my wife because she was like, again, she was a skeptic. She was like, no, you can't do this. This is not possible. And lo and behold, we're doing it and it is possible. So now anytime I get a chunk of money, because I'm a licensed agent as well. So any fix and flip commissions, any commissions from a real estate transaction, I immediately say, okay, this is going into my life insurance policy. That way, it can be gaining compounding interest while I'm still using it to buy another property. So it's great.
And I think one of the fun things is to just, because we all love paying Uncle Sam, we all love paying more in taxes. And you can play a real tax game or play the tax game by the rules. I'm not saying don't pay taxes, but one example in that is rather than taking income from that buy and hold that you have, you can be repaying your loan more aggressively. Your loan, no one pays taxes on loans. Okay. So you're the bank on this. Now you're paying your loan back instead of taking a draw or income from that rental property. You're paying back your policy loan. And guess what? It's still available to use. It's still liquid. The moment that loan does not have to be repaid before you take another policy loan out. And so that's part of the infinite part of this is saying, okay, rather than paying income taxes from what this rental property is doing, I'm going to have it repay this policy loan. It goes back into the policy loan. You need another, buy and hold, fix and flip, or, you have a renter move out. Guess what? You don't have to pay that loan back that month. So there's flexibility on those terms. We've all witnessed a moratorium on rent. How many things have happened in the last 5 years that we never, ever would have imagined in 2019. And that changed really the face of finance forever, where we realized how much power our government has to change the rules very rapidly. But guess what? So this was one fact point that I always find interesting, that whole life insurance predates the tax code. And it's exempt from a lot from those taxes. Now, if we're playing it right, again, if we talk withdrawals, that's a different game. Now, if we're talking loans, no one pays income taxes on loans. And again, that's when we're talking retirement plans, we're putting money into the vehicle and using that money, 100% of that without having to pay taxes on it to live off of in retirement. And then when eventually we pass away, graduate, whatever euphemism you love, die, that death benefit reimburses the loan and everything left over goes to beneficiaries. So again, it's just using this money multidimensionally and starting to understand how that can work for our benefit.
Well, one of the things Jason said that I mean is powerful is he said it's uninterrupted compounding interest. And that's enough right there for anybody to say, okay, if I have some money, let me put it in here because it's uninterrupted compounding interest. So you're going to always get that interest compounding year over year, month over month, and it's just increasing your net worth. So it's a no-brainer.
Yeah. Well, should we look at
That's
another?
awesome. Thanks, Marcus.
Yeah, thank you.
Yep.
Yeah.
Feel free, Marcus,
it's
to
so
be
neat.
that Valerie and chime in on some of this too, if you want to.
Yeah,
Okay.
yeah,
Okay.
for sure. It's so neat, you know, as and I think Marcus has stated, even it's like once you see it, you're like, oh, you know, Troy Miller runs iCore out here in Colorado. He says it best: once you see it, you can't unsee it. And it's so true. It's like, oh man, this really, I can do this, you know. So yeah, it's fun. So yeah, again, thanks Marcus for coming on and sharing some of your own story.
Yeah.
Let's dive in.
I mean, Matt real quick says, can you pay back a loan in full the same year or following month without any penalties?
Mm-hmm. Yeah. It's an unstructured loan. If I borrowed 100,000 out, I can pay it back tomorrow. I can pay it back in a week, a month, a day, a year, 10 years. Never. I wouldn't recommend it, but you can. The insurance carrier is not asking for the money back because your cash value is part of your death benefit. Let me just show this real quick since this is the next one anyway. Far right column is the death benefit. Let's give me a highlighter here. Far right column is the death benefit, which is much higher than the cash value. And so if you borrow the cash value and never pay it back, they'll reduce it from the death benefit and pay the difference to the beneficiary. Okay. So we can get on a call with you guys one-on-one and kind of drill down on some of the design of the policy and how it works really behind the scenes, what's going on. Yeah, happy to talk about that. I want to show this example here. This is a guy who was doing, younger guy, he was doing 25 a year through a policy. Early on, he actually was going to utilize it for wholesaling in the first few years, got into fix and flips, you know, like years 3, 4, 5, 6, 7. And then you see where the red box is, where the arrow is, he's got now a couple 100,000 built up inside the policy. And so I was asking people, if you have $200,000, is it better to pay cash for 1 or down payment on 4 in the context of real estate investing? Drop a number, hold up a finger, you know, what do you got, Marcus? 1 or 4? You know, 4, absolutely. We like leverage, you know. Yes, we want to get everything away from the banks, but when we can leverage that kind of money and buy 4 properties, then do it. Okay, so he's going to take $200,000 out. He's going to put a down payment on 4 properties. He's going to finance the rest. Okay, now let me put that up here. And then the $50,000 per property, he'll pay back over a 10-year period. He just says part of rents. We've done the math. It makes sense for him. He's going to pay that $50,000 per property back over a 10-year period. Well, so obviously I can't update this slide every day because the interest rates are bipolar. But so when I made this one again, it was 6% and it made sense. So it still makes sense. You know, even if it's 8%, it still makes sense. Anyway, policy loan was costing him 4%. He's going to pay it back a 4% rate. The rest of it, he's financing at 6%. So he bought the 4 properties, typical monthly rental income, insurance, M&R, stuff like this. Okay, going on. So now he's got 4 properties producing rental income. And then over that 10-year period, he's paid himself back. And now, to explain uninterrupted growth, uninterrupted compounding inside of the policy, year 1, where the arrow is, he took $200,000 out. That was effectively the entire principal amount that was in there. Any other vehicle, it's growing on what you left in there. So it's only growing on the 7,000 and change that he left in there. You see that? Any other vehicle. In here, it grew as if the 200 never left. So by the end of 10 years, let's say 9 years, 364 days later, he's held out all the money, and then right at year 10, he's going to pay it back, the full 200. He'll have 386,000 and change down here. And then the minute he pays that back, he'll have 586. You know what I mean? He's obviously going to pay it along the way. But just to illustrate, even if he didn't, even if he held out that principal 200 for 10 years, the cash value is going to be 386 down here. So it grew as if the 200 never left. That, in this example, is $148,000 net growth, factoring in cost of insurance as well over a 10-year period. Does that make sense? So what does that do? That's effectively an extra $14,800 a year that you didn't have before, available to use for something else. So now you not only have your rental income, we don't want to change your rental strategies. We want to change the flow of the money. So not only did he get the rental income and the home equity growth, he's also got $148,000 in net cash value growth over that 10-year period. And it's just a fantastic vehicle to do that. All right, I'm gonna skip this. Let's do one more big one. All right, based off a true story. So we have, let's say you've got $500,000 built up in your policy at whatever year. Okay. So this is actually based off of Stan Bullis, who owns Unbridled Companies. They bought this Grant Street mansion downtown Denver. If you're ever in Denver, go down there and check it out. Beautiful piece of property. And did this massive historic renovation on it. And then his companies was renting the office spaces. And he had a $400,000 a year mortgage on that property by the time he found out about IBC. So then the question became, I wonder what happens if I push this money through a policy first. What if I put that mortgage money through a policy first? What do I gain from that? And let's crunch the numbers. So if you remember in both examples we looked at, and Olivia alluded to it early on in the Debtor Saver Wealth Creator, year one, you're just not getting out as much as you're putting in. So for him, year one, he could put 400 in the policy, but he can only get about 260 out. He can get about 280 out. He got 260 out. So that left him 140,000 short. Does that make sense? So we needed to pay 400 total to the bank, but he could only pay 260 through the policy. So he needed an additional 140. So 400, 140. Anyway, so that's $540,000 in rents that he ended up charging the company for rents, and it funded that policy. All right. So rental income, again, is funding that policy. You don't buy a property like this looking at tomorrow either. How much is it going to make me tomorrow? You are thinking long range when you buy properties like this. When you're buying multifamilies, when you're into big deals like that, you're thinking long range. You have to. Yes, you want some immediate return because it's nice. But if you can make a fortune later, you would wait. Delayed gratification. You have to have that patience. Why does it matter in this situation? Well, here's a graph of those numbers. And I'm not going to get too into the weeds here, but the gray, which you can see hopefully, is his cumulative policy outlay, whatever that year is. So over 10 years, 400,000 a year, that's 4 million. You with me? The purple line right next to it is the cash value available that year. Now, in his case, the first 15 years, the intent was to take max loans out and pay off the bank. So every year you want to take max loans out and pay off the bank. And then we reduce premiums just like we did on the first example at some point. And you'll see here from years 10 to 15, he had 4 million to 4.5. So over 5 years, he only paid 542,000 in premiums. So we've reduced premiums quite a bit. All right. But his cash value grew 4.6 to 6.5. So you paid in what? You want to round it $500,000 in, got $2 million growth. right here. So 15 years in, you start paying that back. If he took 15 years to pay that principal loan back, he will have amassed 15 million in cash value, ready to turn and use again. They're using it along the way. They're not going to wait. As they have cash value, they can utilize it. So year 30, he put 6.1 million in throughout his entire life. He's got 15.7 million in cash value, and we haven't even talked about the death benefit, which is way up here. $25 million death benefit. What does that do for a company in his case? If he were to pass away, that company will wipe out any existing loans, and the difference will pay out. And that company will recover all of its premium costs that it ever paid if the company's paying for it. So hopefully that'll get kind of the wheels turning and just show you there's options, there's ideas, and often it's just how do we change the flow of our money? That's the question. What are we going to do with it? Okay. So think about it. Anything you want to add to that? All right.
Questions?
So I'm going to wind it down here. As I talked about, the need for generational thinking. I think we can, I want you to understand we can use these policies throughout our entire life, make us money or save us money. But then I'm going to skip ahead here. I'm going to use the example. I'm going to back up. This is the graph of the guy who was doing $25,000 a year for a while, and then we reduced premiums. But for him, by retirement, he's using it throughout his entire life. By retirement, let's say age 70, he's built up 1.7 million in cash value there. His cash value is growing over $100,000 a year. So at this point, you see he's only paid $590,000 in premiums, 1.7 in cash value built up. We are going to stop funding the policy that year, and then we are going to start taking a $100,000 a year loan out to live on income tax free. And he could do this for the next 20 years in his case. 100,000 a year, 20 years, that's $2 million. And if he lives to age 90, he will pull out $2 million, income tax free. He will have only paid $590,000 in premiums throughout his entire life, and he will still leave $1.4 million out to the beneficiary. Okay. So it's just a phenomenal vehicle you can utilize throughout your entire life. All right.
So we have one question. Are there options for monthly, quarterly, or yearly premiums? Yes. So you can actually pay it a few different ways. There premiums paid in two different categories. One category, the lesser amount can be paid monthly or annually. The bigger category, which is 70 to 80% of the total premium, can be paid monthly, annually, or as available. And I personally have mixed and matched all of those payment options almost every way I can on my personal policy. And so my husband and I are currently paying our smaller amount monthly, and our overfunding amount is being as we have money available to put it into our policy. So we have a full calendar year to pay into our policy.
Yeah, that's a good question. What other questions do we have? We've got a few minutes here. We'll kind of wind down the questions. I'm going to go ahead and put our information on the screen here. For some of you got to go at the top of the hour. Well, we're past the top of the hour, but I know some of you have to bounce. But anyway, there's our information. Reach out to us. Let's talk. Let's see what your situation looks like. Again, drop your questions in the chat if you have any. Just as a point, Olivia and I do not charge. We don't charge for the education. We don't charge for the strategy planning. We want to help you find something that will work for you. We will help you implement and issue that policy as well. So in the end, yes, the insurance carrier pays us, but you're not putting money out of pocket to pay us to help you along the way. And then, as Olivia joked about earlier, you're kind of stuck with one of us for the rest of one of our lives, So, so we'll come up with something good. We'll get to be good friends, and have some good strategies for you guys. What questions are there?
All right, Victor's typing. What is the insurance company? Okay, great question. We have a few that we work with. As I mentioned before, not all insurance carriers are created equal. Our preferred carrier, for a million reasons, and I can list a few of those, insurability, we'll get there, is called Emeritus Life Insurance. They merged with another company that I found out after I was licensed and already doing this. My great-grand-uncles, after World War II, they started working for Acacia that merged with another company and became Emeritus. So I'm quite literally in the family business and had no idea. It was very accidental. I'm doing a very different type of life insurance than my grandfather and my great uncles. So Emeritus is our favorite carrier. A lot of reasons. One reason is that they are designing products that work very well for infinite banking. So some carriers behind the scenes, they're like, we know this thing exists. Y'all stop doing it. We don't want to do that. Why? Because that means you are using that premium that they wish that they were putting into play somewhere else. Okay. So we want to work with people who want to work with our clients. We're not going to, like, if anyone else ever says that, we're not going to write business with them. That's fine. We love Emeritus because they're designing great products for infinite banking. And they're very stable. They've been around for over 150 years. So if you think about that, that's the Civil War. That's 2 world wars, the Great Depression. They are not concerned about the short-term ups and downs of our financial world. Insurability, let's see. Yes. So I always let the insurance carrier tell me someone is not insurable. And I can do that a few ways. I can ask hypothetical questions. I have somebody right now who's a cancer survivor that we're putting through underwriting because they're past the 5-year mark. They're healthy. They're receiving great, regular checkups and doing well, but I want to get that person insured. I have other folks where we check in. If you're not insurable, you can actually own policies on someone else. There's also other ways that we can have the insurance carrier. Another reason why I love Emeritus, they make business decisions. It's not AI deciding your health rating. It's actually a human actuary who's calculating a little morbidly the statistical analysis of when he expects you to pass away, or a range of what those numbers look like. And I've had him change health ratings for the sake of my clients, which was a really big deal. So if you're not insurable, you can buy insurance on business partners. You can have insurance. So you can have a policy on other people, which is also really helpful. It depends, actually. So you might be rated. So again, this is where infinite banking is very helpful. It depends on, I have a friend who has MS, and I'm still trying to get her to do a policy with me because I'm pretty sure I can get her insured. It depends on are you stable in regression? There's a couple of different questions that are added onto that. But you can also have own policies on other people. So that doesn't eliminate you from implementing the concept itself. We also write business with other carriers. And so if that's the situation, we can actually shop around with some other mutual carriers and say, who's going to give us a yes? So again, I don't say no until I hear a no. And I'm always looking for if I get a no here, okay, great. How long until I can get a yes, or what is needed for me to get a yes on this? So, I don't say never.
Yeah. Good question. How much to get started?
Yeah.
Go for it.
Is that another question in there? How much to get started?
How much to get started?
$1 million. Just kidding.
$1 million.
It is very independent. Everyone is a snowflake. Every situation is unique. And that's where Jason and I go to work. And we are figuring out what makes sense for you. What can you afford? Again, this is not a plan for, we have year 1 funded and we have no idea how we're going to fund next year. That's not how this works. We are building a plan for the rest of our lives. Okay. Our lives, meaning we're your agents, and your life, meaning your life, you're the insured. And so we're figuring out how to match make in that of what are your goals and dreams? What are your income and expenses, assets and liabilities? What is your cash flow situation? And how can we make this work for you? So there's no minimum to get started. I mean, the scale of this, just for example, my smallest client started with $100, let's see, $300 a month. She was 17 years old. My largest client to date is a multiple of that. So tack on a few zeros, it's 300,000 a year. And so that was what he can afford. And that's what he's using his policy for. Also a real estate investor. And so any age limitations? Not really. So again, this is where individual conversations would be helpful. And I say not really. There's different requirements. After 70, they want you to do an EKG. Again, a nurse does the medical exam on that. They're just making sure that you're healthy and going to be around for a while. The age, my mom started a policy when she was 64. It's, I think her policy is 5 years old now. And so it's working for her. She's used it a few different ways. And so again, the way the policy is designed, the numbers still work out, which is really fun. Regardless of health rating, regardless of age, we can still get money to start growing for you multidimensionally. So.
Yep. Good questions. All right, guys, you've got our information on the screen. We will send an email out probably tomorrow if you attended, and just say hi, and feel free to get back to us with any other questions. You have both Olivia and my email on there. If you want to just do a quick scan, it'll take you to a landing page where you can schedule your own time as well. And then we will get you guys going. Again, call us. It doesn't hurt to ask questions. We are educators. We're not sitting here trying to push people to buy policies. We want to educate you on it. I want you to have something you're going to be happy with the rest of your life. It is whole life insurance. You want to be happy with something you got to pay for the whole rest of your life, and you need to understand it. Get the book. Get Becoming Your Own Banker. Read it, and get your head wrapped around it a little bit. I read that book every year. I teach it, but I still read it every year, and I still go, oh yeah, 77 pages. You wouldn't think so, but yeah. So reach out. Thanks for coming, guys, and sticking around. I know it was a long haul. Appreciate you sticking on the full time. We look forward to chatting with you individually and get you guys your own privatized family banking system going.
All right. Thank you.
Thanks,
have a great evening.